Hello friends. Last week in this video, I advocated that the bulls had a fair chance of pushing the market higher and the probability was that the market is likely to go higher rather than fall. What really went wrong? What were the factors that made this calculation go wrong? And what can happen if the same factor was to persist in the market in this coming week itself? Let's find that out in this video because cause and effect theory tells you that unless you know the cause, you will not know what the effect is and how long that effect can last. So let's use our in-house indicators, rational logic in trying to analyze this market. And to that extent, you'll have to stick with me till the end of the video to find out what were the factors that brought the market down and whether they can persist in the week ahead. So let's plunge right in. And coming up on your screen is the market roundup window, which tells you both the indices fell. The Nifty fell a little more than the bank Nifty. The selling was broader based. Safe haven buying returned in bullion, which you can see that gold and silver both went up. Crude shot up again because the war in Ukraine tended to prolong, and the Moscow incident, the sinking of the Russian battleship in the Black Sea, the Moscow, with Ukrainians claiming that their missile Neptune has hit that ship, is spooking the markets all over again. Natural gas continued its upward march, and the Dixie, the US dollar index, finally closed above the 100 mark, and that's pretty negative for emerging markets, including India. The USD INR, which is the dollar versus the Indian rupee, has also risen, but relatively less, which tells you that the Indian rupee is still trying to hold on to its own ground. However, the biggest aspect that worries me is the 10-year benchmark bond yield, which shot through the roof to hit 7.29% intra-week before settling down at 7.23%. And expectedly, the NSE market capitalization fell 0.77%, which is a minor mercy because the fall could have been significantly higher. The MWPL, or the market-wide position limits, rose, which is routine because till the third week of any derivative series, MWPL does tend to go up. Overseas Qs were negative as all the three indices were down. Do remember, this is another consecutive week where the Nasdaq is down, and as I told you last week, the Nasdaq being weak, our technology stocks can witness a drag, and you really saw what happened in the week gone by. So now on your screen is the daily MWPL chart, which you're seeing is rising, but rather sluggishly. I told you last week itself that the 32 to 34% band is now a recent memory. We've not seen 30% plus MWPL for a while in any derivative series, and unless that happens, the two marshmallow traders are not exhibiting any signs of commitment or enthusiasm. Let's see the weekly MWPL chart now, which shows a rally in the MWPL itself, but it's relatively muted. The slope of the up move is muted. We want a more proactive increase in MWPL, possibly past the 30%, 32% mark before we can actually be enthusiastic here. Looking now at the daily chart of the index and individual stock futures turnover, you can see that both have shown a week-on-week decline. This is not really surprising because it was a short week last week, 3 trading sessions instead of 5, and a very, very long weekend. So risk appetite did tend to be low, and it's along expected lines. Looking at the same chart on a weekly basis for a 20-week look-back bias, you can see that the turnover in the stock futures is at a month low, which is not exactly very good news because now Even one marshmallow traders are not showing signs of optimism. The index futures turnover is at a 3 week low, and that I told you partially can be explained by the fact that it was a very long weekend. The Nifty and Bank Nifty daily chart of the basis. Now, the basis is nothing but the premium enjoyed by the futures over spot, tells you that the basis has actually halved on both the indices from 233.2 to 113 on the Bank Nifty and from 94.4 to 43.6 on the Nifty 50. This is not exactly very good news. Although some of it can be attributed to the impeding approaching expiry, because basis is a decaying asset. It's the highest at the beginning of the derivative cycle and tends to fall, all other factors remaining constant as expiry approaches. So part of it can be explained to the time decay, but halving, a fall of 50%, is not something that's very good news for the one marshmallow traders. Now look at the basis on the weekly compression chart. Do remember what I told you last week, friends, that the basis jump on the Bank Nifty was unlikely to be sustained. And there you have it, a precipitous fall after a steep rally in the week before last. And last week you saw much of that gain in the basis being eroded. That is not really surprising. What's worrying me is the basis decline in the Nifty 50. It surrendered almost all the bases it gained in the week before last, and is now currently still treading water in the upper end of the 20-week range. We need to watch this metric very carefully. If you connect with me on social media, my contact coordinates come at the fag end of this video. I update these metrics, all of them, on my social media account at the end of the day. So do connect with me and update yourself in real time. Now let's take a look at the advanced decline ratio, another metric or a gauge of activity of the one marshmallow traders. It remained above 1 for 2 trading sessions out of 3, and it has closed at the high of the week at 1.25. Now, there are two ways to look at it. It's the high point of the week at 1.25, and the other is that 1.25 is not exactly a very gung-ho, especially after the fact that it was five times almost a fortnight ago. So whether the glass is half full or half empty, it becomes that kind of a quandary. But I am of the school of thought that 1.25 is not exactly showing excessive signs of commitment or strength on the part of one marshmallow traders. The same chart seen in the weekly compression is showing you that the basis has fallen on a week-on-week basis, and barely a fortnight ago it had climbed to a peak of 5.01, and now we are 1.25. So it's 1/4 of what it was a fortnight ago. This is clearly not very great news. Now for the impetus of the bank and the Nifty 50. What you are clearly seeing is that the impetus has fallen on all 3 trading sessions on the Bank Nifty, and it has fallen on 2 trading sessions for the Nifty and flatlined on Wednesday, which was the last trading day of the week last week. What it basically tells you is that volatility is falling, intraday ranges are falling, and traders are increasingly feeling more and more benign, frustrated, and they are not participating with the kind of gung-ho enthusiasm that they were. That, of course, you would have seen from the traded volume of the indices and the individual stock futures. Now let's take a look at the impetus over a weekly chart, and 20-week period tells you that the impetus has fallen sharply on a week-on-week basis across both the indices, and that's not exactly very good news. So although the indices were trying to attempt to make bottoms and rise, the impetus was not really supportive of the move. Let's now go to the LWTD chart, the lift weight thrust drag indicator. On a daily period basis, what you are seeing is that the LWTD has come above zero on Wednesday, which was the last trading day of the week, but the index still remains negative, which means that on declines, the market might attempt to seek support and some buying might emerge. However, I must caution you about all indicators that I'm showing you in this video only for this week. The cautionary note is only for this week. Do remember that these indicators are reflecting the price action as on Wednesday. A lot of water has flown under the bridge on Thursday because our markets were shut for local holidays, whereas international markets were open. And Friday, Saturday, Sunday was again a holiday. So these holidays have seen a lot of sentiment shift, rethink in the mind of investors and traders. And on Monday, it could be a whole new prevalent sentiment. So do remember that while I do expect support to come at lower levels, this is not exactly a full lift. It is not a lift. I would categorize this as drag. All right, drag. It's attempting to rise, but upward mobility will run into some amount of pressure. Now the same LWTD chart seen on a weekly compression period, what we are seeing is a slightly better picture. The Nifty, which is the blue line here, is plunged below zero, but the LWTD has risen very, very mildly on a week-on-week basis, which I told you is because one is expecting some amount of support coming in at lower levels. Last week, I clarified to you the reason why I expect this support to come. It's very clearly the LIC IPO, and the biggest player of them all, the Government of India, Big Brother, is interested in pushing through the IPO of LIC before the Fed raises interest rates and potentially easing or pressurizing the equity markets. So this is precisely because of strong hands being interested in propping the markets up that you are seeing some support coming in at lower levels. Now for the footprint of the four types of traders out here, what we are seeing is the FII's footprint first, their individual stock futures and index stock futures. Both positions have been lightened up. What you are seeing is falling open interest. Let's take a look at what DIIs have done. What they have done is basically cut very small exposure on the short side on the index futures. They remain net short, but their short position has come down marginally, and their individual stock futures short positions have increased very, very mildly. So they are maintaining a status quo more or less. Now for the prop traders who are a proxy or the next best thing to insider traders, because these guys know what's happening, who's buying and how much. So they tend to be super sharp traders. They've basically increased their individual stock futures long positions, and they've stepped up their short positions on the indices. So they've taken a hedged approach. Net longs in individual stocks have gone up, and net shorts in index futures have gone up as well. Now for the retail traders who have been doing most of the buying and heavy lifting in the last few months and few quarters, they've basically gone ahead and gone overboard and buying index futures longs, which they have multiplied almost 10 times, and where the individual stock futures long positions are concerned, these exposure levels have also gone up marginally. So retail traders seem to be absolutely gung-ho. Friends, the indicators done, I now come to the crux of this video as to why the market fell. And will it continue to remain under pressure in the week ahead as well? You see, any trader will confirm what I tell you is if there are two charts of different time frames, say an hourly chart and a daily chart, you might want to enter intraday basis based on the hourly chart, but you cannot afford to ignore the higher time frame chart. So what happens if the hourly chart is bullish and the daily chart is bearish? Which will have greater impact on the price? I think all of us would admit here that it is the larger time frame which will prevail over sentiments over time. Similarly, the equity markets, you will be surprised, are the smallest in terms of turnover and global footprint worldwide. The largest is the currency market due to the sheer razor sharp and razor thin spreads and 4 decimal points that it trades in. And the second in turnover, but the highest in importance, is the bond market, because this is the source of all funds for all the other three asset classes: currencies, commodities, and equities. And I have been telling you, and even in my last week's video, I told you that bond yields going up above 7% and climbing even higher tells me that either the bond market suspect inflation, or they suspect interest rates to go up, or in the third case, the absolute worst case scenario, both the inflation and the interest rate to go up, which means the cost of money, cost of funds, which is the interest cost, is likely to go up. Now, when interest cost goes up, everything from corporate cost, raw material cost, to transportation, etc., etc. Do remember that these are inflationary times. As it is, fuel and other prices are going up, raw material prices are going up, and it is the bond market's worry. Remember the hourly chart weighing down the 5-minute chart, or the daily chart weighing down the hourly chart. The larger time frame overpowering the smaller time frame. So the bigger market, the bond market, dragged the equity markets lower. Whoever is in touch with me via a free WhatsApp broadcast list, have been warning you via WhatsApp messages as to what is happening. I have clearly told you via WhatsApp messages that emerging market interest rates are likely to go up, and I remember sending you a message, will Indian bond yields rise further? And I gave you logical reasons as to why bond yields need to go up and will probably go up till the June Monetary Policy Committee meeting, or the MPC of the Reserve Bank of India, or the RBI, is called for. Now, what you can see on your chart on your screen is the 10-year benchmark bond yield with a 3-month and a 1-year moving average. The blue line is the bond yield. It is now clearly at its highest of the time period of 6 months. But let me assure you that the bond yield, if you were to check on any free charting software website, is at its highest after May 2019. That's 35-month high, which means the expectation of a rate hike is at the highest in almost 3 years. This is something that will unnerve equity markets. Can equity markets be even more nervous coming week? Hey, it'll all depend on the 10-year benchmark bond yields. From 7.28, 7.29, where it peaked out last week, if it goes to 7.3, 7.3, 7.35, 7.40 next week, yes, in that case, I think the market might fall a little more. So those of you who thought you can shut your eyes and trade equities by monitoring only equities, you're running a big risk. All these markets are interconnected, and the bond markets have the highest influence on equities, and particularly if you are a bank Nifty trader, it has the highest impact on banking stocks. So if you want to shut one eye and trade with half the perspective that you should be having, go ahead and do it. But I would suggest follow my 360-degree worldview approach and look at every variable factor that impacts the price, because hey, that can lead you to losses. So monitor the bond yields very, very carefully. Keep your bond yield chart window open throughout the trading session in this week ahead. Friends, the bond segment done, and the most important segment, like I said it was, I now come to the US dollar index, a very critical US currency benchmark, and it impacts the emerging markets scenario. Last week, it gained 0.66% and it rose on 3 out of 4 trading sessions, which you can see on your daily chart on screen. And a round number of 100 has been overcome on a sustained closing basis on Wednesday. The price remained above its 25-day exponential moving average, which is a month-long holding on cost of an average bull, which means the short-term outlook remains bullish. And the blue trend line, which I have drawn from end of May 2021, is acting like a fantastic support, which means even the medium-term outlook will remain optimistic unless and until this trend line, which is currently placed at 97 levels, is violated on the downside. Looking at the same chart with a weekly compression now, what you are seeing is that the price has made a good sized bullish candle, although there is a big or a noticeable upper shadow or a wick. That means the intraweek high at 100.77 could not hold. Some amount of profit taking came in. Do remember, in the overseas market also, Friday was a holiday due to Good Friday, so it was a very long weekend for them as well. So a little bit of profit taking can be expected. The price, however, remains above its 25-week exponential moving average, which means the medium-term outlook also remains positive for now. Friends, last week I advocated a range between 101.15 on the upside and 98.5 on the downside, which held perfectly well in spite of all that volatility. Next week, I expect a range between 101.80 on the upside and 99.15 on the downside. Let no one tell you that the Dixie is not important because it impacts the price of landed fuels, gold, silver, chemicals, base metals, etc., everything. And if the dollar is going up, we are importing inflation. So inflation has a very major fallout if the US dollar index was to rise sustainably. Friends, the US dollar index done. I now come to the bank Nifty, which I told you has taken it on the chin thanks to the bond yields. When bond yields have risen, that means bond prices have fallen. When bond prices have fallen, there's a big mark-to-mark portfolio loss of the banks because they are the largest holders of bonds. Especially the HTM, hold to maturity portfolio, has taken a big hit. Now, the Bank Nifty, as you can see on your chart, has lost 0.76% on a week-on-week basis, and it fell on 2 out of 3 trading sessions. Mercifully, on Tuesday, it attempted to rise, but it turned out to be an abortive rally. It's kind of consolidating sideways since the last 5 or 7 trading sessions, and we need to see which way the cookie crumbles. The price remains above its 25-day exponential moving average, which means the short-term outlook remains positive for now. And do remember the bump and run reversal, the 2 oblique trend lines that I have drawn, where you can see the price has retraced from, in the month of April, a bullish green candle, and thereafter a red bearish candle, which is almost retracing 3/4 of the prior bullish candle. Now that's a bump and run reversal signal, and that's acted beautifully in curbing the rally of the Bank Nifty. Now for the weekly chart of the Bank Nifty, what you are seeing is a very small bodied bearish doji on the weekly chart on your screen. The price remains above its 25-week exponential moving average, which itself is flatlining. That's not very comfortable. So the medium-term outlook remains optimistic as long as the price remains above this moving average, which means possibly 36,500 odd levels, give or take a little. And what we are seeing is, on the weekly chart, the bump and run reversal, a lower trend line, has acted as a resistance on the prior week's bullish inverted hammer candle, what you are seeing. And what is likely to happen is that the closer it gets to 39,500 odd levels, the more the Bank Nifty is likely to encounter some amount of selling. Friends, in the week before last, this index was at number 2 of the most volatile list in the derivative space, but it fell 2 notches to fall to number 4, which means the volatility on the Bank Nifty is easing, which is confirmed by the fact that A, the volumes were lower, B, the impetus of the Bank Nifty has fallen. In the previous week, I advocated a range between 39,675 on the upside and 35,825 on the downside, which held perfectly well again because obviously it was a shorter week, so a lesser number of threat perception or volatility enhancement days. In the coming week, I expect a range between 39,300 on the upside and 35,600 on the downside. Friends, the Bank Nifty done. I now come to the most liquid, low impact cost traded instrument on the derivative segment of the NSE, the Nifty 50 futures. This index lost 1.74% on a week-on-week basis, and as you can see on your daily chart on screen, has fallen on all 3 out of 3 trading sessions last week. Now, this isn't exactly very great news, and the price, though remaining above a 25-day exponential moving average, which is a proxy for a month-long holding on cost of the bulls, which means the short-term outlook remains positive as long as the price remains above this level, but the index itself is flatlining or going sideways. We want the price to go higher above this average, and the average must also be rising. That's when enthusiasm comes in. So do monitor the round figure data of 17,000. If the price sustains below this level, I think you have a slight problem on your hands. Now, friends, let's take a look at the weekly chart on your screen. What we are seeing is a bearish candle after a very small bodied doji in the prior week. And the price mercifully is still above its 25-week exponential moving average, which is a proxy for a 6-month holding on cost of the bull. Therefore, the medium-term outlook remains optimistic for now, but only as long as the price is above this average. What we do need is this average to rise in tandem with the price so that the bulls can come back into the buying ring again. Friends, in the week before last, this index was at number 10 on the most volatile list, but it fell 3 notches to fall to number 13 on the most volatile list. That, of course, is you've been confirming that with the lower volumes and the falling impetus reading on the indicator as we checked earlier. In the prior week, I advocated a range between 18,425 on the upside and 17,125 on the downside, which held perfectly well, mostly because it was a very short trading week and therefore very little volatility was to be seen. In the week ahead, I think we estimate a range of 18,125 on the upside and 16,825 on the downside. The large range is because of the high base effect of the volatility that is prevalent. Friends, the Jensen's measure and the Traynor ratio are not exactly very gung-ho about fresh purchases. I would want you to take extra care, trade light, stay sharp, and maintain your stop losses diligently. This is not exactly a time to be an aggressive risk taker, especially in the leverage space, because both your profits and losses tend to be very exaggerated. So let's be careful out there and play a safe game. Friends, the index section done. I now come to the most popular segment of this video, wherein I give you 5 stocks which are low impetus, low beta, where you take big exposure and wait for small price moves, and high impetus, high beta stocks where you take small exposure but wait for large price moves. Which direction do we trade in? Hey, that depends on the snapquote window. Remember this video that I had made for you. If you watch this video all over again, I'm providing the links in the comment below, in the description below this video, and in the end screen of the video itself. If you watch this video, you'll be able to read the screen on the snapquote window and take intraday positions multiple times a day. So these are not necessarily buy recommendations. These are counters that you will trade. Which direction will you trade, long and short? Maybe you can go long and short multiple times on the same day itself, depending on where the snapquote window tells you. So let's rush into the names of the stocks. The high beta, high exposure list stock list is led by HCL Tech at number 1, number 2 Persistent Systems, number 3 Wipro, number 4 LTTS, and number 5 JSW Steel. If you notice something, majority of these stocks are directly and indirectly linked to technology. And I had told you last week that the Nasdaq is likely to weigh on Indian technology space, and there you have it. The low beta, low impetus stock list is led by Indus Tower at number 1, Abbott India at number 2, Bajaj Finance at number 3, ICICI General Insurance at number 4, and number 5, Ultratech Semco. Friends, this hierarchy of high and low beta stocks can move from day to day, because volatility can compress and rise hour to hour, day to day. And if you do connect with me on social media, I update all this data on my social media accounts. So you can remain up to date by connecting with me. My contact coordinates will come at the fag end of this video. Before I sign off for the day, my friends, I wish to remind you to click like on this video if my work helps you become a better trader. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. Good, bad, or ugly, I welcome your feedback in the comment section. And please do help us to reach out to fellow like-minded investors and traders by referring my video to your family and friends. I thank you for your patience by watching my video and staying with me in this long video. I wish you have a very, very profitable week ahead. Thank you. Take care. Bye-bye.